Stocks are slipping and Treasury yields are climbing. Here's what the latest jump in oil could mean for your money. Markets are recalibrating as crude rises again. Investors worry that higher fuel costs could slow disinflation and keep interest rates elevated for longer. That concern is pushing long-term yields up and pressuring rate-sensitive parts of the market. The tone has turned cautious while traders wait for fresh inflation and jobs data to guide the Federal Reserve's next move. Oil is the catalyst. Tighter energy markets and steady demand are lifting benchmark prices. Higher fuel costs can seep into transportation and manufacturing. That makes the Fed's job harder and can nudge both nominal and real yields higher. When yields rise, growth stocks and speculative tech usually feel it most, along with other long-duration assets. At the same time, energy shares and some commodities-linked plays often find support. If oil strength persists and price pressures prove sticky, the start of any Fed easing cycle could be pushed back. Rates are back in charge. 2-year and 10-year Treasury yields moved up as traders cut expectations for near-term cuts. Fed officials want clearer evidence that inflation is cooling in a lasting way. Upcoming CPI prints and labor data are pivotal. The question is whether core measures keep moderating even as energy costs climb. Equities are tilting defensive into earnings season. Benchmarks edged lower, led by high-valuation and rate-sensitive segments. Investors rotated toward sectors seen as more resilient to higher financing costs. Energy names got a relative boost from crude. Companies with heavy fuel and freight exposure face tougher questions on margins, pricing power, and demand elasticity. Analysts are watching to see if earlier input cost relief is reversing at the margins. Global markets are mixed. A firmer dollar and higher yields tighten financial conditions worldwide. European and Asian investors are weighing the oil move alongside their own inflation paths and data-dependent central banks. Currency swings add another layer to returns for globally diversified portfolios. Here's the practical takeaway. Expect more day-to-day chop while the market tests higher for longer. Favor quality balance sheets, steady cash flows, and sensible valuations. Within bonds, keep duration in check and watch inflation break-evens. Be selective with growth and speculative names. Consider measured energy exposure, but size it to your risk. Most of all, let upcoming data guide changes rather than headlines. Read the full article at finlitica.com.